Global equities have been off to a great start this year. That's because investors are looking beyond what is likely to be a recession. Instead, they're focusing on the fact that the Fed might be near or close to the end of their tightening cycle. We're cautious that investors are getting a little too complacent, though, and not factoring in what an economic downturn can do to the equity market. At these levels, we see more downside potential for equities than we do see upside potential. When it comes to the economy, look at this chart. This is the leading economic indicator index. It has a tight correlation to the S&P 500. This has been falling rapidly, so this poses more downside risk to the equity market. Valuations are again getting a bit unrealistic in our view. We're seeing valuations rise at a time when we still don't have inflation under control. The Fed may be near an end, but we're not sure if it's completely the end. We're looking at earnings that we think still need to come down. We would estimate earnings need to come down another 5 to 7% this year and next year. Also, margins will continue to be pressured. These things should weigh on equities. In the very near term, we're looking at a negative seasonal period for equities as well. May and June tend to be the weakest months of the year for equities. And then when you look at just history and recessions, typically equity markets don't bottom until you're well within a recession. So we're looking at equity markets rising, and we haven't even seen the recession yet. So what does that mean for equity investments? First of all, don't completely abandon equities. For the long run, equities are still the place to be. And also what we think in 2024 and beyond is that once we clear these excesses out of the economy that were created because of the pandemic, we finally put inflation behind us and the Fed gets in more of a stable interest rate policy. This is great news for equities, and this can set us up for a multi-year bull market in equities. From a positioning perspective, keep dry powder right now, because what history does tell us as well is there's often opportunities to put money to work in leading up to a recession, in a recession. We still like the small and mid-cap space because it's one of the better areas of the equity market, especially in the U.S., that do better coming out of a recession. Don't forget international equities. From a valuation perspective, they're still historically cheap, especially versus the U.S. So we would favor that international space. Don't buy into the euphoria that you may see right now. Instead, be patient. Take a look at your portfolio. Rebalance where necessary. There's been areas of the market that have risen what we think just unsustainable levels, specifically large cap growth, technology. Be patient. Have the dry powder to put to work because there will be opportunities, and we'll continue to look for them within our equity allocation.